So what happens to your money if you have it at a firm like Schwab, Fidelity, or Vanguard, and God forbid they go out of business, right? That'd be an awful situation. And you want to know, is my money safe? Do you need to worry about that? So in today's video, I'm going to talk about what I consider to be the 4 main protections that you have for any account like that. I need to preface this video by saying that, anything can happen, but in general, I think you're okay, but you don't want to think you're okay. You want to know that you're okay. So let's go for a walk and I'll share the 4 main protections that you have. And frankly, the 4th one is the one I consider to be the most important because it's a structural protection. How is a brokerage house different than a bank? I think it's super important, so please be sure to stay around to the end. Okay, the first, you've probably heard of SIPC insurance. It's similar but different than the FDIC insurance. So the SIPC insurance has a higher limit. It's $500,000, including up to $250,000 of cash. So that limit, if you had $250,000 of cash, then it would only cover the additional $250,000 of securities. It's also important to note that the SIPC classifies money market accounts as securities, not as cash. We often think of our money markets accounts as kind of cash equivalents, but what really matters in a situation like this is how does the insurer, which is the SIPC, how do they view it? And they view it as a security. So your first layer of protection is the SIPC insurance. Historically, according to the SIPC website, above the limits, then if there was a recovery at a firm, and there have been firms that have had wrongdoings, the SIPC had to shut them down, and then the SIPC works to recover those assets and return it to their owners. And according to the SIPC website, their recovery rate has been 99%, which should give you some comfort that if you have money above the limits, boy, that recovery rate is super high. But like a lot of things, the past is not necessarily indicative of the future. So that's your first layer of protection. Your second layer of protection is similar. It's called excess SIPC insurance. So firms like Fidelity, Schwab, Vanguard will actually buy insurance on the open market to protect the accounts above the SIPC limit. I was able to find what it is for Fidelity. Fidelity has $1 billion, but it's important to remember that's for all of their customers. And Fidelity, these are big firms. Fidelity manages, shouldn't say manages, they have $10 trillion of assets under administration. And Schwab, Vanguard has $8 trillion in assets under administration, and Schwab had 7. So these are big firms. So the fact that they have $1 billion of insurance, typically by firms like Lloyd's of London, that sounds like a lot of money, but that's for everybody, right? But at least it's something. And again, you combine that with a 99% recovery rate historically with situations like this. And that's an extra layer of protection that I do think should give you some comfort. The third layer of protection is really, these are highly regulated industries, the brokerage industry. There's a lot of rules. The firms are regulated by FINRA. There's also SEC regulations that take place, which means regulators are going in, making sure they're abiding by the rules, trying to do what they can to make sure that the firms are strong, solid financial companies and playing by the rules. So the fact that there's those regulators in there and the rules really, I think, adds an important layer of protection. Of course, we saw with the Silicon Valley Bank situation, things can unravel quickly, right? I mean, we're going to find out, but the rumor is that Silicon Valley Bank was playing by the rules. They were aggressive with their investments. There's lots of politicians, many people in the public saying, Silicon Valley Bank should not have been allowed to have such long duration bonds in their portfolio. And we'll know a lot more, in the coming months. But we see how quickly things can turn around, and how regulators can miss things like, you know, mismatch or more aggressive investments. But the word on the street is they were playing by the rules, they just weren't managing their risk well. So the third layer of protection are those rules, are those regulators, but obviously it's not perfect. Now, I promise that the fourth layer of protection is what I thought would be the most important. Let me jump into that. I do want to share at the end, I'm going to give you one bonus related point that I think is super important. So stick around just a little bit longer. Okay, the fourth layer of protection is just how brokerage houses work. You're not giving your money to Fidelity, Schwab, or Vanguard to let them use it and to give loans to other people or to run their business. Essentially, your assets are segregated. Your assets are your assets, which is different than a bank. When you give a bank, you know, let's say you deposit $100,000, that bank can take your money and loan it to somebody else. That's not how a brokerage house works. If you put $100,000 in a brokerage house and you put it in a money market account, or just leave it in cash, they can't use that asset for loans or any other business purposes. That asset is segregated. It's almost like if you had a safety deposit box at a bank, right? The bank can't open your safety deposit box and take the money out of there, or whatever you have in there, and loan it to somebody else. That's kind of how brokerage houses work. It's segmented assets. They're your assets. And in theory, the way all of this is supposed to work is if one custodian went under, then in a perfect world, you're just transferring the assets that you already own, you know, that are, you know, have your account. You're just doing an account transfer from the custodian that failed into a healthier custodian. That's how it's supposed to work. I don't know how it would actually work if, God forbid, that were to ever happen. But those are the four main layers of protection. Again, it's SIPC insurance, it's excess SIPC insurance, then it's the rules and regulations. This is a highly regulated business. And then finally, just the nature of the fact that this is your money, and the custodians I should have said brokerages. The brokerages are not allowed to use it. So that's a critical difference from a bank. Now, what's this important point I want to share with you at the end? And that is, as long as we're talking about this, as long as we're talking about brokerage houses and custodians, I think it's really important that if you ever work with a financial advisor, that financial advisor is not the custodian of your assets. This is really important, and unfortunately that's what happened in the Bernie Madoff situation. Bernie was both the advisor and the custodian, and so he could make up any numbers that he wanted, and unfortunately he did. So if when you're shopping around for a financial advisor, you know, I always say I think you should look for a fee-only financial advisor. You can find a fee-only financial advisor by Googling fee-only financial advisor and find somebody to work with. But importantly, they should not custody the assets. You should be getting monthly or quarterly reports on here's what your investments are, here's what the returns have been from both your financial advisor, but then also separately from the brokerage house. So that's the last point. Pretty serious topic, a lot of information here. I hope you found it helpful. If you did, do me a favor, hit the like button. It really does help other people find videos like this that can benefit from it. So please take a second, hit the like button. It means a lot to me. Also leave a comment. I love reading the comments. I try to read as many of them as I can. I usually get through most of them. And try to comment on a couple dozen of those. So hopefully I get a chance to comment, reply to one of your comments soon. So thanks for taking a minute to do that. And until next time, I'm Azul, encouraging you to take full advantage of the youth of your senior years. Remember, you're only young once. Use your time wisely.